everyone. Welcome to Chart Attack. This is Vishal from Equity.GURU, and today we're talking about the big CPI data which came out for the month of March of 2022. A lot of people were expecting this. You know, the leaks were sort of given out yesterday when we were told that CPI was going to be extraordinarily high due to the situation in Russia and Ukraine. And well, here we go. CPI rose 8.5%. Hotter than expected and the highest since 1981. Surging food, energy, and shelter costs helped account for the gain there. And I believe without or ex-food, there we go, excluding food and energy, CPI or core CPI increased 6.5% on a 12-month basis. So, you know, this is the chart that we've been looking at for CPI. Of course, there's not necessarily technicals that you can apply here, but I'm just saying, you know, we had that breakout basically back in June of 2021, and you know, we're seeing basically what is a 40-year highs now for inflation. So we haven't been in this type of situation once again, you know, since 1981, as the article here has said. But some hope. A few analysts are expecting that this is the peak for inflation. So this is Andrew Hunter, senior U.S. economist at Capital Economics. Big news in the March report was that the core price pressures finally appear to be moderating, and he thinks that March increase will mark the peak for inflation as year-over-year comparisons drive the numbers low and energy prices subside. And then there's another analyst who talked about inflation, and this is from chief economist at Pantheon Macroeconomics. Overall, this report is encouraging at the margin, though it is far too soon to be sure that the next few core prints will be as low. Much depends on the path of used vehicle prices, which is very hard to forecast with confidence. And we're sure they will fall, but the speed of the decline is what matters. So, you know, transitory inflation, supply chains, and now Russia. And it seems a lot of the contrarians, you know, we're saying that no one's really talking about the excessive money printing to the tune of 8 trillion that was printed, or I think somewhere about 80% of all US dollars ever printed was printed in the last 2 years here. So inflation coming in hot. Let's take a look at how the markets basically responded to this. We'll start with the bond market, where the 10-year yield, which, you know, it did hit over 2.8% today. It was actually up for the day when the data was released, but now it's gone red. And you would expect, of course, the yields to rise, because if inflation is coming in hot like this, you're expecting that the Federal Reserve will have to raise rates a few times, you know, 6 to 7 times this year, plus a few more next year. So you should expect interest rates to be heading higher to, you know, basically front-running Fed rate hikes to combat that inflation. We'll take a look here at the S&P 500 and the NASDAQ and the Dow Jones. All markets red. There was a bit of a pop today. But essentially, all I can say about the markets is that we basically closed below major support level that we've been watching. And I've talked about this on our Discord channel. So if you're not a member of our Discord channel, you know, do join us over there. We had that breakout yesterday, and you can see so far price is now rejecting this 44 or 4,500, well, 4480, 4450 zone here. That is now what used to be support, now acting as resistance. So we are expecting some more downside here in the markets and the NASDAQ, you know, very similar chart structure there, where we broke below a support zone yesterday. Today, we saw that retest and sellers jumping in. And the Dow Jones is still the only outlier here, but maybe today is the day we get the breakdown on the Dow Jones, and basically all US markets are now feeling that pressure. So, you know, when interest rates rise, people are expecting maybe bonds to be yielding a bit more. Hence why money might transition from stocks to bonds. And a lot of people argue that, you know, markets have been inflated these past few years because of the low interest rate environment, basically making bonds not a great, you know, investment vehicle. And now money will leave stocks and run into bonds once interest rates start to rise. I'm going to leave you off here with the chart of gold, because I know there's a lot of gold, you know, bulls and bugs here. And this, you know, this range in gold that's been going on since the middle of March, basically ranging between 1900 and 1960, had a lot of people sort of frustrated. But I've been saying this looks pretty good compared to Yields were moving up. The US dollar was also rising. Both of those would have been very bearish for gold, right? A lot of people were expecting, hey, yields are popping. Gold should be just getting smacked down, right? Because gold yields nothing. So if bonds are yielding something, why would you be putting your money into gold for safety when you can put it in government debt? But, it's held. And I look at that as a bullish sign, could be maybe indicating more fear and uncertainty. Maybe the markets are not pricing or don't think the Fed's going to hike many times. Or perhaps it's still the inflation trade, right? That these 6 rate hikes by 25 basis points is not going to be enough, to basically combat what are we at 8.5% inflation. And maybe, we have to actually hike in the double digits, sort of like what Paul Volcker did back when the US had a bout with high inflation. And hence why money is, running into gold here. So for you gold bugs and bulls who like gold and even silver or hard assets as an inflation hedge, gold is looking like it's ready to break out here above 1960. We still have a few more hours left in the trading day here, and we could easily sell off and close back below and maintain this range. But I'm going to say if gold can close above 1960 here, that is a range breakout here. And as long as we hold this breakout zone, we're looking at 2060 and perhaps even beyond. So new record highs in gold. Not new record highs in gold, because we actually do have record highs up here around just a little bit above 2070. But basically, gold is going back above $2,000 if we get this breakout confirmation here, all from this inflation report here. So what do you guys think? Is this the peak for inflation, or are we going to see, CPI and inflation keep rising as we go? And I remember, I think it was last year where we were hearing about inflation is only going to be transitory till middle of the year, and obviously that didn't come to be true. Analysts have called for the peak of inflation in the past, hasn't happened, but maybe they're right this time. What do you guys think? Let me know in the comments below. I really want to hear what you guys have to say here. Be sure to follow Equity Guru at all our social media links provided in the description box below, and I'll catch you guys all in the next chart attack video.